Welcome to Business with Louis, the show where we explore the latest trends and insights in the world of entrepreneurship and commerce. Today, we're going to talk about a concept that's gaining increasing attention: sustainable finance, balancing profit and planet. That's where sustainable finance comes in. It's an approach that seeks to balance profit with planet, ensuring that businesses operate in a way that's not only economically viable, but also environmentally sustainable and socially responsible. But what exactly is sustainable finance? Simply put, it's a business strategy that integrates environmental, social, and governance factors into financial decision-making. This means considering the long-term consequences of business operations on the environment, society, and the economy, rather than just focusing on short-term gains. The concept of sustainable finance has been around for several decades, but it's gained significant traction in recent years due to growing concerns about climate change, social inequality, and economic instability. Today, investors, consumers, and regulators are increasingly demanding that businesses adopt sustainable practices and report on their ESG performance. So, what are the core principles of sustainable finance? At its heart, it's about adopting a triple bottom line approach, which means considering not just financial returns, but also environmental and social outcomes. This involves assessing the impact of business operations on the environment, such as greenhouse gas emissions, water usage, and waste management, as well as social factors like labor practices, human rights, and community engagement. One influential thinker who's contributed to the development of sustainable finance is John Elkington, a British consultant and author who coined the term triple bottom line in the 1990s. Elkington argued that businesses should prioritize not just financial performance, but also environmental and social sustainability, recognizing that these factors are interconnected and essential for long-term success. Another key concept in sustainable finance is the idea of stakeholder capitalism, which emphasizes the importance of considering the needs and interests of all stakeholders, including employees, customers, suppliers, communities, and the environment. This approach recognizes that businesses have a responsibility to create value not just for shareholders, but also for the broader community and the planet. Let's look at some real-world examples of sustainable finance in action. One notable case study is Patagonia, the outdoor apparel company that's been a pioneer in sustainable business practices. Patagonia has implemented a range of initiatives, from using environmentally friendly materials to reducing waste and emissions, and even providing on-site childcare for employees. The company's commitment to sustainability has not only improved its brand reputation, but also driven innovation and cost saving. Another example is the investment firm BlackRock, which has launched a range of sustainable investment products, including ESG-themed exchange-traded funds and impact investing strategies. These products allow investors to align their financial goals with their values and support companies that prioritize sustainability and social responsibility. So, how can business students or aspiring entrepreneurs apply sustainable finance principles in their own ventures or careers? First, it's essential to conduct a thorough sustainability assessment of your business operations, including supply chain management, energy usage, and waste generation. This will help you identify areas for improvement and opportunities to reduce environmental impact and social risk. Second, consider offering sustainable products or services that cater to the growing demand for eco-friendly solutions. This could involve developing new products made from recycled materials, designing more energy-efficient processes, or providing services that support sustainable lifestyles. Third, explore sustainable investment options, such as impact investing or social entrepreneurship, that align with your values and financial goals. This might involve investing in companies that prioritize sustainability, supporting crowdfunding campaigns for environmental projects, or participating in community development initiatives. To measure and report sustainability performance, tools like the Global Reporting Initiative and the Sustainability Accounting Standards Board can be helpful. The GRE provides a framework for reporting on ESG factors, while SASB develops industry-specific standards for disclosing sustainability information. As you embark on this journey, be prepared to face challenges like higher upfront costs, changing consumer behaviors, and the need for ongoing innovation. However, the rewards are well worth it. Enhanced brand reputation, improved risk management, and access to a growing market of environmentally conscious consumers. According to a study by Nielsen, 75% of millennials are willing to pay more for sustainable products, indicating a significant shift in consumer preferences. In conclusion, sustainable finance is not just a buzzword, but a business imperative that requires us to rethink our priorities and practices. By balancing profit and planet, we can create a more resilient, equitable, and thriving economy that benefits both people and the environment. As my colleague on Wall Street once said, sustainable finance is not a trade-off between doing good and doing well. It's about doing better by doing good. So, take the first step today, and remember that every great business starts with action. Make your next move count. That's it for today's episode of Business with Louis. Like, share, and subscribe. And remember, every great business starts with action. Make your next move count.